Very client seminar. Glad to see you all here. For those who don't know me, my name's Anthony Street. I'm one of the financial planners at Berry. We've got a pretty full agenda, so we'll get it kicked off. But just to start, a bit of a disclaimer. So just to note, we're going to be talking about a lot of stocks and strategies, and so it's just important to know that's sort of just our general views and whether or not it's suitable for your own individual circumstances would need to be talked about a bit further. So before you take any action, please talk to somebody at Berry about the things that you've got in mind. So on the agenda, and just an admin point, we'll email out all the slides from today. So quite happy for you to take notes, but just everything that's up on the slides we'll email out to you. So first up, Nicole Raffin's going to give you a technical update on the new super rules and regulations. Then Alex Clement from Macquarie's kindly come along to talk to you about the Macquarie Income Opportunities Fund and a little bit about the fixed income market and give you his perspective on that. Then our investment committee, which are the three guys here, and with special guest Tuan, are going to give you their views on the market and some insights that they've got on particular stocks. And for those of you that attended the last couple of briefings, you'll know that they do have a fair bit of knowledge and experience. And I saw a Warren Buffett quote the other day that said it's better to hang out with people that are better than you. And so Mark and I try and hang out with these guys as much as possible. And so really that's a main part of this presentation, is to give you guys some exposure to them and ask, basically as many questions as you've got about their views on companies or markets or strategies or whatever. So I'll introduce them all a little bit later, but first up is Nicole Raffin. And Nicole's worked at Berry since 2011. Before that, she worked at Raffin as the technical specialist for self-managed super funds, and she also spent 8 years at Macquarie as a technical advisor for financial planners. So Nicole started her career at Zurich in various actuarial roles and is a fellow of the Institute of Actuaries and a fellow of the Financial Services Institute of Australasia. Welcome, Nicole.
Excellent. Good afternoon, everyone. Okay, so what I'd like to cover today in our superannuation technical update is a couple of key things to be aware of. So firstly, superannuation contribution caps, marginal tax rates and Medicare levy. One of the key changes I'm going to talk about today is something that's coming soon from the 1st of January 2015, deeming of account-based pensions. And that is relevant for age pension and also for Commonwealth Seniors Healthcare Card holders. Look at changes proposed to the pension age. Look at some changes that have come in already for aged care, and just quickly touch on some other recent developments. So when looking at contribution caps, as you'd be aware, there's two types of contributions, concessional contributions and non-concessional contributions. For concessional contributions, your cap this year depends on your age at 30 June 2014. So if you happen to be 49 or older, your concessional contribution limit will be $35,000. If you're younger than that, it will be $30,000. For non-concessional contributions, the annual limit from this financial year is $180,000. Now, if you are under 65 at any time during your financial year, you can bring forward 3 years' worth of contributions. And 3 times 180 happens to be $540,000. If you came to last year's presentation, I discussed how the treatment of excess concessional contributions has changed, and so now it's not so detrimental if you do happen to exceed your concessional contribution cap. Effectively, from 1 July 2013, excess concessional contributions are simply taxed at your marginal rate. Now, exposure draft legislation has recently been introduced. There's a proposed change so that excess non-concessional contributions will not be so detrimental anymore, because the large penalty that currently would apply won't apply anymore. Instead, under the proposal, excess non-concessional contributions would simply need to be withdrawn from super and any associated earnings on those amounts. So what that means is it won't be such a financial heartache if you did exceed your contribution caps. So that's good. We would still continue to monitor clients' caps because, for one thing, for example, it's important not to trigger bring forward of non-concessional contributions at an inopportune time, which would mean you couldn't get the maximum amount into superannuation. Excellent. So next, looking at the marginal tax rates and Medicare levy, and the big change here is that the top marginal tax rate is now 47%. That includes the temporary budget repair levy of 2%. Now this temporary increase applies for 3 financial years. Also, the Medicare levy has increased to 2%. So it used to be 1.5%, it's now gone up to 2%, and that is for everyone. And Medicare levy surcharge can also apply depending if you have sufficient private health insurance. But assuming you've got sufficient private health insurance, the top marginal tax rate would be 49% in total, alone for Medicare levy as well. Now that continues to cut in at taxable incomes of $180,000 and above. Now because Medicare levy has gone up from 1.5% to 2%, it makes it a little bit more of a slightly more expensive issue, and it's one reason in our planning notes that we've been preparing for clients, which I think Mark is going to talk a little bit about today. We're looking at pointing out to you that if you pay a death benefit to the estate rather than to a non-tax dependent, you do avoid paying Medicare levy. Although if you do pay benefit to the estate, there are probate costs to consider, and those costs do depend on the size of the estate. So it's something to weigh up there. Now the big change that's coming soon is deeming of account-based pensions. So this is going to come in from 1 January next year, and there is grandfathering of existing arrangements. I say that a couple of times in this presentation, so as not to panic any of you.
Excuse me, Nicole, can you explain what grandfathering is?
Yes. Grandfathering, thank you, Judy. Grandfathering is something that Techo people say, meaning just like your grandfather is the nice one that buys you the lollies and the treats and the ice creams and lets you stay up late and all those things. The grandfathering, when the government introduces the legislative change, the grandfathering helps people who have planned under the old arrangements to still get the benefit of those old arrangements. So, thank you. Yeah, but let's just look at what these rules, what these changes are. So there's 2 ways that you could be affected by this. One is if you are affected by the age pension, means testing, or if you have a Commonwealth Seniors Healthcare card or looking to get a Commonwealth Seniors Healthcare card. So the current treatment of an account-based pension for age pension, so Centrelink, is that there's a deductible amount based on life expectancy, and then you take your pension payment from that pension, and the pension payment less the deductible amount is what Centrelink sees as being your income from that pension. So that's the current rules. The new rules will be that that account will be deemed. Now what does deeming mean? Deeming means that you're assumed to earn a certain level of income on your assets, regardless of what your investments actually earn or what drawdown you actually take from the pension. You're just assumed to earn a certain amount. Okay, so you can see it's quite a different system. Now in terms of Commonwealth Seniors Healthcare card eligibility, currently, so to get that you have to be age pension age, so currently 65. So your account-based pension is tax-free pension income because you're over 60, okay? And Commonwealth Seniors Healthcare card is based on adjusted taxable income at the moment. So because your account-based pension is tax-free income, therefore it's not part of adjusted taxable income, therefore it's simply disregarded. Now that's all going to change, and these accounts will become deemed. So you can see that's quite a big change. Again, it is grandfathered for existing arrangements.